Welcome back to Building Blocks for Apartment Investing. When investing in an apartment syndication, how often should your money double? What's a good investment amount for a beginner? What's a sophisticated or accredited investor? Trevor Thompson is here to answer all those questions and more. Don't forget to like and subscribe so we can continue to bring you professionals with awesome information to help you with your investing career. Enjoy the show.
So Trevor, you just mentioned one deal where I think you said 18 months that you tripled your
Yeah, it was 20 months. Yeah,
20 months, excuse me, that you tripled your investment. So let me ask you, if in that deal, can you remember what the going in cap rate was and what your exit cap rate was? And what do you use as a parameter when you're looking at these deals in terms of beginning and ending cap rate or going out cap rate?
Yeah, so if I remember correctly, they went in like just under 4, and they had budgeted to go out at 4.5, but they got bought out at like 3.2. Like it went way the other direction again, because Tucson is on fire, right? It's Tucson, Arizona. It's on fire. It was before the interest rates. In fact, it had a retrade because their interest rate did go up a little bit. So we were actually going to be 3.5 times, but they said, hey, we don't want to lose this deal. We're quite happy at 3 times. And it was an interesting one because they took it over, and to be honest, it was a little bit slow on the transition. And I was looking at it going, ooh, these guys, because it was a really rough property. But then once they got going, they got traction, and basically they cleaned up the whole property, just made it look nicer. They actually only renovated 20 out of like 170 units. And someone else saw the vision, saw the meat on the bone, and went in there and unsolicited offered a very good number to get out. We rode the big wave in. We caught that one big wave. This is not normal 3x in 20 months. So I want to make sure that's reasonable. People understand that, right? Like, you're looking for deals that are about a 15 plus IRR. You're looking to double your money every 5 years, roughly. That's kind of normal. And every once in a while, my first 2 passive investments, to be honest, I made no money. I just got my capital back. So in theory, I needed a home run to get caught up. I had 2 more that have gone full cycle that delivered exactly what they promised. This just was because of how hot the market was and how hot Tucson, Arizona is. That's why that one did so well. But again, I'll take it.
Okay. You just said that one of the investments didn't perform exactly as you expected.
Yeah.
How did you exit that deal?
Yeah, so that was one of my first 2 investments. Both didn't just return their capital. And 2 big things happened that really affected the deal that I didn't know to look for. And these sponsors should have thought it through. So what happened was they became super aggressive in Texas at collecting real estate taxes. Super aggressive. So Texas has no state tax. It has massive property taxes, massive property taxes. And then the second thing that happened between Katrina and we called it Snowgeddon, insurance rates doubled. So now all of a sudden they had a much bigger tax grab than they anticipated. They had a much bigger insurance take that they never considered. And then, COVID happened. And so you've got those kind of 3 tsunami things. And COVID really hurt low-end income housing, right? Because those were the first guys and girls to lose their jobs, right? The hostess at the restaurant lost their job, and the kitchen guy still managed to work, and a DoorDash guy delivered it, but the hostess, and so a lot of our people were in that service industry bucket, and they were the first ones to get let go. And then even though rent relief came, I'll be honest, the quality of the tenants weren't right. So for example, when the relief checks came in, I thought one of the investments, I actually helped manage it for a while, even though I was only an LP, I was asset manager. And I thought, okay, relief checks came out. People are going to come and pay rent. There was 25 big screen TV boxes in the dumpster. They bought TVs. They didn't pay my rent. Because again, it was that sort of the mentality of that, I call them second chance tenants. There was a lot of second chance tenants in this property. And second chance tenant means you've been evicted from a nice place because you didn't pay your rent. And then so you go to a not so nice place because they're desperate to fill and hope that you pay your rent. And so you need to understand those things, right? What are you investing in, right? Those ones can have huge returns. The one in Tucson was exactly that. It was full of Section 8 tenants, some college kids. It was known as a party property, but they cleaned it up, got that out, started putting some good tenants in, fixed up the pool, fixed up the entrance, put some gates around the property, and then boom, it turned into a very successful property.
Okay.
So it can happen, but again, risk reward often is tied in, right? So if you want to invest in real estate and you want to be safe, okay, I have an investment in a medical center in Mesquite, Texas. It's a 10% pref payment. That's it. It's almost like a loan. And, every quarter I get my 10% pref equity. But again, it's a safe thing, but there's no big win in it, right? It's just a triple net lease. There's no risk because the tenants, if there's a leak, the tenants have to pay for it. One thing I found out that was quite interesting, doctors not only sign from their practice, but they sign personally for their leases. So for a doctor to skip out on his rent, he's got to lose everything. So it's very safe, but it doesn't pay big money because it's very safe, right?
So some of the things you've talked about thus far with the team, a sponsorship team, you talked about doing your due diligence. You talked about finding out who they are. Do your due diligence pretty much on the deal itself. Okay. So now I've done those things. I've interviewed the sponsors. Now I'm ready. I am ready to invest. With the first time investing with a new group, is there a certain amount that someone should do with their initial investment? And what is your feelings on that?
Well, so most deals have a minimum, often around $50,000. So if you want to try to invest less than the minimum, which I have been able to invest less than the minimum on some deals, but you need to be sure that they would accept that. But most deals have a minimum that you have to do. Some deals it's 100, most are 50. There are some that are 25. And there's some other ways maybe to get into deals, but it's a big threshold. And this may be too much data again. So I was able to get in for less than the minimum because I'm considered an accredited investor. But for sophisticated investors, they're only allowed 35. So there's the max there. And I also had to agree that if a bigger person came in, they could kick me out. So if someone said, well, I want to come in and I want to put 100 in, well, Trevor's 25 is gone. The minimum was 50. I put in 25. If Cedric comes along here, he's a rich dude. He says, I got money and I want to put it, but I don't want to put in 50. I want to put in 100. I want to put in some of them have maxes like 300 or 500. I want to put in that. They're going to kick me out as a little guy because they would much rather have one investor than 5 investors. It's just easier to maintain.
Okay, you kind of opened a little bit of a Pandora's box. So for our listeners, please explain accredited investor and sophisticated investor.
Yeah, so an accredited investor is someone who meets a certain financial threshold. Simply, and you can find it on the SEC website, but it's or just Google accredited investor. But it's basically somebody with an income of $200,000 a year with the expectation the next 2 years would be that large. 300 is a family, or you have a net worth of more than $1 million excluding your home. Sophisticated means you've started done some of your homework, right? You've read some books, you've read some webinars, you've come to these groups, you've joined some sort of mentoring program. So sophisticated means that you have knowledge, you have enough knowledge to be considered that you understand the investment. And I want to go one step further because you mentioned at the beginning, you can only invest in with a $5 or $6 B syndication, and you have to have a substantial relationship. So you guys need to know Cedric or William or myself. We have to have had some meetings. I have to understand. And again, you want to make sure that you are connected with people that know you, know what your financial needs are, right? Because some people need cash flow. So like I just closed in on a deal this week. It's not going to produce cash flow. So I told one lady, this is not, she said, I need cash flow. So this is not the investment for you. You probably won't see any money for about 18 months. And it's similar to bigger win at the end when you sell. This isn't the deal for you. And, you know, because you want to invest with people that understand what your financial needs are, right? At the beginning, it's all about wealth preservation, right? You don't want to lose any money, but you also need to make sure that you know, when is my money coming? So for example, I'm invested in a new build. You don't make any money till that new build sells. My storage, you don't make any money till it's built and at least 80% leased up. No cash flow at all. So that can be somewhere from 18 months to 3 years with nothing coming back to you. So you need to know, be sophisticated enough to know, hey, I can't live on that. You know, I need to put this money, this $50,000 in, like I did on the medical, and I want to make sure I'm getting at least $5,000 a year because I need that money to pay my bills. You want to make sure that you understand that those types of things before you invest at all.
Thanks for explaining accredited and sophisticated to our listeners. So thus far, we've pretty much been talking about passive investing, but I know that now you're doing some active investing. So how was your transition from passive to active?
Yeah, so it happened out of necessity. I lost my job at the COVID. You know, iFly went into, you know, preservation versus growth and development. I was on the growth and development side. And I'm going to be honest, being an active investor is not for everybody. It's not for the faint of heart. A lot of people think, and a lot of mentorship programs teach you, oh, it's really easy. You just get a bunch of people, make a few phone calls, people send you money, you buy an apartment, you hire a property manager company, and you sit back and this money rolls in. That is not true. That's why you want a good sponsor. You want somebody who's full-time, who's dedicated, who has someone in the area of your investment that can take care of it. If something happens, you know, they're not at work saying, I can't answer the telephone, I'm at work. Now you want to call somebody who this is their full-time job and say, hey, we got a problem here. There was a fire, there was an incident, there was a crime, there was an accident. You want to make sure that you're investing with people that have that. And as an active investor, you assume all of the risks. So I'm going to give you, my first active deal was $240 in San Antonio. We were trying to do a loan assumption. 6 months and $350,000 later, we did not get approved. My first past active deal, I put $75,000 at risk and I lost it. Now, we also collected $6.1 million in investor money. Every penny went back to the investors. They lost nothing. So that's the big difference between active and passive. Active is you're the guy dealing with it. Yes, you hire a property management company, but property management company, I call them the path of least resistance to the easiest result. That's what a property manager company is. They want to do as little as possible to make sure that the property runs as well as possible. That's what it is. Unfortunately, that's what most businesses in America are. And you want to have people that want, no, I want extraordinary results out of my property. Just like the one I got in Tucson, right? Those people pushed, they actually switched out property management companies in the middle of the ownership. That caused a lot of bump and rattles and things that happened. But the end result was this person was dedicated to make sure they were watching my money that was invested in their deal.
Okay. So what can you take from active investing that you can apply to passive investing?
Again, I know in theory, because I was a volunteer asset manager on a property, but I got to tell you, for me, just the sheer responsibility that I took a bunch of people's money and promised them I'm going to do a good job. That's super like scary now, because, you know, I've been putting that pressure on other people. Now that pressure's on me. And it's an interesting switch around, right? Like, you know, we're gonna go close this week on the 75 doors in San Antonio. And it took us a long time to get there. And we know the current owner hasn't done anything since he got it under contract. So we're walking into a mess, and we're prepared to walk into a mess, but you know, we got to turn it around and make sure that our investors' money is not only safe, but in a very quick position to be able to start providing some cash flow.
Okay. So where are you now with your active investing?
So just before I got on the call, I got a text that we finally, 4 months, got approved on a loan assumption. Took 4 months to get approved, and a lot of paperwork and a lot of tears. It hasn't come through email officially. It was just, they wanted to call and said, tomorrow we'll get an exact closing date. So that's my second active deal. The first one I joined someone else's deal. This one is as a co-sponsor of 75 doors in San Antonio. So
Good. I'll just say this real quick. I had heard that the assumptions, they do take quite a while, you know, and it's funny because I'm actually looking at a deal right now that is a loan assumption.
yeah.
But right now, just because of the state of the economy and
Yeah.
the market, those are the deals right now that are going to be the ones that are trading, unfortunately.
It is definitely. And the one that I lost the money in was a loan assumption. And what had happened was we were assuming a loan. We had a third party pref equity position, and then we had investor money, and we could never get the lender to approve our third party pref equity position. And that's what ended up making us lose the loan in 6 months. And we had to do 3 loan extensions, which was all at risk money, pay for a second loan application, hire specialty lawyers that were supposed to make sure that everything was worded that way it would get approved. You know, so I went a pretty painful path through that. Luckily on this one, it was just slow and super meticulous because they already got somebody on the hook for the loan. So why do they want to switch it and put somebody else on the hook? They got nothing to gain. They don't make any more fees. So they're super cautious, and everybody's doing them now. And those departments aren't as big as the other departments within the loan organizations. And it's a Fannie Mae loan, so it's a government loan, and we all know how fast the government works. Hopefully there's no government workers on this call I just offended, but you know, it's a lot of bureaucracy.
Okay.
That was awesome information from an awesome professional. And he has more gems to drop in our next episode. If you would like to support this channel, one of the best ways to do that is to like, comment, and subscribe. All those things signal to YouTube that you see value in these videos. So make sure you click that alert button, and I'll see you in part 3.